I'm amazed at how slowly the media reacted to Monday's announcement of new mortgage rules impacting domestic buyers, given how much attention has been paid to affordability. After all, the new mortgage rules will make it more difficult for people trying to get into the market, first-time buyers, especially in major urban centers like Vancouver. Have you noticed you've heard nothing from the grandstanding politicians who demanded the government do something, or the constant group of protesters demanding the latest entitlement, affordable housing, in places like Vancouver? Well, it's less affordable now. Where are they? I mean, along with those in the media who milk the familiar refrain of government can wave a magic wand and control the real estate market. As I stated on Monday, in the immediate aftermath of the announcement, 10 minutes after the announcement, I quoted H.L. Mencken's famous line, "Be careful what you wish for, you just might get it good and hard." Ozzie Jerk's going to join us later to discuss his big change in outlook for real estate thanks to the new rules. But right now, I'll focus on the impact on the overall economy. And I'm amazed how little attention it continues to receive. Of course, that's the norm. I mean, there's so much hollow talk from all the power groups, politicians, organized labor, big media, about jobs, economic growth, and it's utter BS. There's so many examples. The mortgage announcement is just the latest. Please note, there was not one forecast downgrade this week. There was one more, rather, forecast downgrade this week for Canada's economic growth, this time by the International Monetary Fund. OECD was a couple of weeks ago. This is the norm in Canada. I'm not just being glib, but I see no sign that our political leaders, special interest groups, even the Bank of Canada understands that globally we're in a deflationary environment despite all the evidence, starting with lower oil prices, other resource prices, the slow growth environment around the world, despite trillions being spent by government and record low interest rates. We are still in low growth because of a deflationary environment. The only sector in the country what was escaping that deflationary trap has been real estate, well, at least in major urban centers. And the new mortgage rules are deflationary. We should think about that. One of the consequences of the low growth environment and the accompanying record low interest rates is that Canada's overall debt compared to GDP is now 290%. That is worse than Italy. And as the IMF correctly points out, high debt results in lower economic growth down the road. That's another gift we're giving to our children. I hope you memorize that number. You look at the overall debt in Canada, it's now 290% of our GDP. We still don't seem to get that we need economic growth in order to create jobs, pay for health care, senior entitlements, and secure the standard of living for the younger generation. That's not a political statement. You misunderstand if you think it is. It's math and finance. Now back to what worries me about the new mortgage rules impacting domestic buyers. One, Canada's growth is already anemic. Oil and gas resources in general haven't recovered. Manufacturing hasn't recovered. The U.S. economy is slowing, and now according to the Department of Finance, the new mortgage rules are going to cause sales activity in real estate to drop by 8%. My bet is that they're underestimating the impact. I'm not trying to be overly critical, but their models didn't predict the run-up in real estate. Why should I believe that all of a sudden they're going to get it right to the downside? And given the overall state of the economy and the importance of real estate across the country, keep in mind, leading industry in 7 out of 10 provinces, we can't afford a mistake. And why do I think they're underestimating the impact? Well, if you're a regular market player, you listen to here, you understand that all moves tend to go further and farther in the direction of the trend. So if you're in a downtrend, the surprises are further down. If you're in an uptrend, surprises are further up. In this case, the new rules are being implemented in down markets in many areas across the country. People don't seem to get that Vancouver's real estate market peaked in April. I just shake my head that we don't understand that. It's in the midst of a 6-month slowdown in both sales and price. We'll look at Calgary and Edmonton. Their slowdown's been much longer. Well, the new rules dramatically alter the demand side of the supply-demand equation. Fewer people are going to be able to qualify for those low equity mortgages. That's going to be especially tough for first-time buyers. And if you do qualify, it's going to be for a lower amount. Quick example, courtesy of mortgage broker Kyle Green. Someone who makes $76,000 a year, puts 10% down, well, before the new rules, qualified for $500,000 home. Under the new rules, it's a $425,000 home. Genworth, Canada's largest private insurer, estimates that 1/3 of all buyers will no longer be eligible for mortgage insurance. There will also be major disruptions in the non-bank lending side of that industry that will play out over the next couple of years. Banks will be fine. That's who they consulted with. Can't find anyone in the mortgage industry who was consulted on this move. Only the banks, as far as I can tell. My bottom line is that we can't afford any government policy mistakes in this global deflationary environment. That's already prompted the Bank of Canada head Stephen Poloz to go, surprise, expect slow growth environment for a lot longer than originally thought. This comes at a time when demands on government, thanks to the aging population, are record highs. But here's the thing. The new rules are going to slow the economy further. Money Talks is brought to you by Solera Club. For more information, go to soleraclub.com. I'll take a break. A couple of brand new stories by Mike Levy coming up. I've also got Mark Leibovitz. You saw the move in gold. Well, he's going to tell us, is that a buying opportunity? Should we be cautious? Well, Mark's been Timers Digest Gold Timer of the Year. He'll join me at the top of the hour. I got a big fat idea for you. I got shocking stat. I got Aussie with his real estate forecast and Victor Adair live from the trading desk. All of that coming your way, topped off with a goofy here on the Money Talks Network. So much coming your way today. It was a big week in so many areas. Aussie Jurox, brand new forecast for real estate. Mark Leibovitz chatting with me about what's gone on in gold and the big decline there. But right now, I'm pleased to welcome back to the show. Michael Levy's been away. Good to have you back, Mike.
Thanks, Mike. It's good to be back, albeit a little rainy and gray this morning.
Holy smokes. Hey, look, let's talk about the employment numbers first to get off the schneid, as we say, get you back on the horse, Mike.
Well,
I thought it was kind of interesting, though. I mean, we had a decent September, good September. British Columbia leading the way. Ontario's okay. Quebec's okay. But, it's once again, you got to look inside the numbers. And I found it fascinating, some of the changes there when you talk about part-time work, you talk about self-employment.
Well, Mike, first of all, we added 67,200 jobs. That was way above what was forecast by analysts. But as you say, when you dig a little deeper, one of the things you see is the increase in part-time, self-employment. But the other thing that really stood out to me, and this I had not seen before, was the job growth in the 55-plus age bracket that saw a record monthly increase. Listen to this number, Mike. 61,000 people, more people employed over the age of 65 or 55, and the labor force participation, those looking for jobs over the age of 55, is at a record number.
Yeah, and they don't give us any more data on why that might be. Did everybody suddenly get an entrepreneurial rush? I suspect that you're seeing a lot of people who have either retired or have lost their job, and there's nothing else waiting for them, so they now have continued with self-employment.
Well, Mike, I see that too, but I also, digging a little deeper, I think so many people, and this you stress, Money Talks, are coming into retirement with not enough money. So They come out of their jobs, they have what meager pension, unless of course they're in the public service, what meager pension or savings they've got, and they've got to supplement that. And I think these numbers are a real wake-up call to where people who are retiring and have maybe a Canada pension plan or have put away a little bit of an investment account can't afford to retire.
Yeah, and that comes back to the record low interest rates. People sort of promise that if you save enough money, don't worry, that you're going to be able to live safely in retirement on, like, say 7% or 8% return. Of course, that's not possible, and I think that's got to be playing into this too.
Well, I do too, Mike, but the other thing I found was self-employed, and that's at high levels too. People who are going out, and to me, I take a little deeper look at that, and I say, well, are these people who have been laid off, who've come out of the workforce, and now are trying to do something on their own and call themselves self-employed? Again, is this a bigger problem, and does it demand a description or an explanation far above there are more self-employed people?
Yeah, as we said earlier, that again, what we're going to see is that we don't get enough data from all of this stuff, and that's a big change. a big change.
Big change. Mike, just one final thing, and I know you talk about it all the time. It's so important. This affects most of the population. There are the very fortunate number who are on basically in the public service or who have defined pensions, but that's such a minority to most of the working people who have to fend for themselves after retirement.
Mike, let me just change gears for a second. And one of the people I know that you follow is, in the past, he's been the largest bond trader in the world. His company just got purchased, Janus Capital. But Bill Gross, I thought he had some fascinating stuff to say about the investment outlook.
Well, he did, and he tells a story, and I'll tell it quickly, Mike. The people who go to Vegas or Reno or wherever they go to gamble, and they play blackjack, and they've got systems, and they count cards, and you ask them how they did. Well, they've always broken even or made a little money, and figure you can't lose at blackjack. And the reason you can't, in their mind, is you bet. And if you lose, then you bet again. And if you lose, then you double down and bet again. And if you lose again, you double down. And eventually, these players figure that if they put in enough money, even if they keep losing, if they keep doubling down, they're going to, at some point, win and get all the money back. And, Mike, that's called the martingale system. And what Bill Gross did this month was compare this martingale system of putting in more money in the hope that you're going to reach a point where you're going to get your money back and everything will start to go your way. And he compares that to the action of the central banks and low and negative interest rates.
Yeah, that they just keep on. I mean, this is like the old, the cliche, the definition of insanity. You keep doing the same thing and you hope for a different result. Well, I think it is noticeable that we're now in year 8, of this sort of central bank quantitative easing, record low interest rates, government spending at record levels, and yet look at the anemic economic growth right around the world.
Well, yeah, and the accumulative balance sheets, Mike, of zero or negative rate interest rates from Japan and the ECB is now approaching 15. It is $15 trillion, and they figure if they just keep putting money into the system, negative interest rates, 16 trillion, 20 trillion, 30 trillion, eventually it's going to turn around and it's going to get economic growth going because of all the cheap money out there. But, Mike, I think what they don't realize is there's going to be a point where investors say, we've had enough. We don't want negative interest rates. We don't want you taking our money. And they're going to go to other alternative forms of investments maybe where they shouldn't be. And as Gross says, it may perpetrate a gray or black swan event if central banks, particularly Japan and the ECB, don't turn this around.
2 quick points. I know we've run out of time, but one is that what we've seen by the data is that people's response to the record low rates was to save more, for their retirement, not spend it. They want us to spend it. They want us to borrow and spend. The other thing that they seem to be fundamentally incorrect on is that having record low interest rate is actually deflationary in a deflationary trend. We'll have to talk much more about that. I just throw out one of the big economic stories of the year. They've got it wrong, period. Anyways, Mike, it's great to have you back.
Have a great weekend, Mike.
Okay, we'll take a break, come back. I got a big fat idea. Stay with us. Gold has broken down by about $100 in the last, it looks like about the last month. Well, we're going to be talking to Mark Leibovit. He's been Gold Market Timer of the Year. People are asking, is this a buying opportunity or is that it for this run in gold? Well, I'll ask Mark's opinion when we come back here. Also, I've got coming up, Aussie Jurik's going to give us his forecast for real estate. This is a big change, what you've been seeing, and I'll give you another couple of examples. Let's say you had an income of $100,000 per year. Well, the maximum borrowing power for someone who could purchase a $700,000 property, that's under existing rules. The new rules kicking in October 17th. That $700,000 for somebody who makes $100,000 a year has dropped to $550,000. So we're seeing a huge reduction in borrowing power. Maybe it's 15, maybe it's 20%. Well, that's going to result in at least a slower market, especially if sellers don't lower their prices, we're going to be a while to absorb this change. I think it's a very, very significant move in the industry that's strongest in 7 out of 10 provinces. So we'll certainly be following that. As I say, Ozzie Jurek is going to come up. I'm going to be fascinated to hear he has changed his real estate forecast based on that. That's something to keep an eye on. We're having trouble tracking down Jason Ayers, president Learn to Trade Global. But in the meantime, what I'll let you know that there's an option education day coming up. It's put on by the TMX group and featuring the people from Learn to Trade Global, Jason Ayers and Patrick Suresna in Vancouver. It's a week today at the Fairmont Pacific Rim. In Calgary, it's the next day. It's Sunday, October 16th at the Westin Calgary. It's a full day session, includes breakfast and lunch, which is why you got to pay $45. But all you have to do is go to moneytalks.net, click on the banner on the homepage to see the full agenda, decide if it's for you. But I'll tell you this, I believe in this kind of a market environment is absolutely essential to understand how options can both protect you and provide opportunity. One of the things that we're talking about with the big fat idea that I will now post on the website for you, what it is writing, you've heard about Twitter potentially getting purchased. One of the names, the forefront name, is Salesforce. The symbol is CRM. Well, it was at $85 earlier this year. It's now at $67. That's sort of at a retracement low technically. Well, how do you play that? Well, one of the ways you can do it is by selling puts. And if you don't understand that part, as I say, I'll put this up on the website, but if you don't understand the opportunities provided by selling puts, well, I think you're missing a phenomenal opportunity to reduce the risk of any purchase you're making of major stocks. I'll just give you an example. You could sell a November 70 put. That means you're giving someone the right to sell that CRM to you for $70. That's just another month, and you're still going to collect $2.40 a share. So you like the stock? That's a key. You think it's good value? Well, now you've just either got a discount or you're keeping the money. That's 3.5% return in just 1 month. So there you have it. It's a strategy, I think, for intermediate investors. It's a good understanding. Well, that's what you're going to get by going to that program next Saturday in Vancouver, next Sunday in Calgary. It's only $45, but you get lunch, you get breakfast. So go to moneytalks.net. This is a key component of your investment portfolio. I'm going to take a break. I'll come back. I've got Mark Leibovit. We'll talk about gold right off the top. We'll talk about the breakout of marijuana stocks right here on the Money Talks Network.